Hi, Warriors. Who's ready for the consumer pain index today? Maybe it won't be painful. Hey, how are you, Ryan?
Nice grab on the hole yesterday, mate.
Oh, thanks, man. Yeah. Looks
nice
okay.
Bottom feeding there.
Yeah. Before we get going in the markets, I guess the FTX guy got arrested in the Bahamas. Can you guys see these pictures?
Yeah.
Yep.
Oh, okay.
It was about time, wasn't it?
Yeah. Never commit fraud for love. All right. That's all I have to say. I wonder if they had children. Anyway, so what are you guys looking for today? Got a little pop, and the dollar did pretty weak response off this 104 still. I'm thinking we go 102 and change down here, even if we do rally first. I think that lines up with some targets that Katie had. I've seen a 102, enough to everyone will say, well, the big major support gave way, and we trade down here, and maybe the euro trades up towards over the 107 handle. I don't know. Pound, where could that go? 25. Yen, Ryan, you think we had a little bounce, starting to look like an ascending triangle, but maybe we can make another trip down here?
Yeah, it's all possible.
I saw someone talking 131 for some kind of zigzag in US dollar yen.
Some kind of zigzag. Is that a technical pattern? Is it?
I think it was some way.
I think a zigzag is what he used to roll joints back in the day, right?
Oh yeah. I forgot about those.
Sorry.
Yeah, while I was driving.
Sorry, I had to throw that one out.
That's okay. I think you rolled one too.
I had some friends that might have.
I know it was just your
shown
friend.
me how to, whatever.
I was like Bill Clinton. I never. No, it was the opposite. I never exhaled. All right. Anyway, I'm sick as a dog. So, gold still.
Hey, Coach, if you're sick as a dog, I can take over, man. I appreciate you being here, and I know it's a big day for the markets.
Yeah.
And you have a really important interview today.
Yeah, NASA is going to be with us. So
yeah,
with what energy is doing, it's going to be good to have him here.
Yeah. Do you want me to take over?
Yeah, go ahead, buddy.
Yeah, go get some rest, Dale.
Yeah. Go relax your throat for a little bit. And
okay.
And by the way, Dale, I need to say, great call in crude yesterday. Really, really, really great call.
Thanks, man.
Yeah,
you guys call Mr. Dale. Don't mess with the oily coach, I say.
Dale was looking at this, this really big bounce off of 70, and we just got a really big bounce from there. So great call.
Still out. Thanks.
All right. Hey, go lay down.
All right.
All right.
Okay.
All right. Hey, good morning, team. How's it going?
Morning, mate.
Good morning, Ryan. Good morning, K-Man. Good morning, Stelios, and maybe Steve. I don't know if Steve's here. Doesn't sound like he is here. Oh, he is. Steve?
Hello?
No, doesn't. Oh, well, okay. Well, we got a few of you guys here. So tell me, before we get into like what you guys' expectations for CPI are, what happened overnight? What happened during the flow show, during your show that you guys broadcast? What happened that we should be aware of? I mean, the ZEW numbers, even though they're generally speaking pretty weak, they did come in better than expected, right?
Yeah, it's a volatile number. It did come in less negative than expected, but still sentiment is let's say it's not really good, is it? No. But everything is going to be overshadowed by the CPI today. I mean, we did get some numbers out of the UK, average earnings slightly lower than expected, really. not even going to move the needle today in terms of markets, I think, because we're all waiting for CPI and the Fed tomorrow.
All right. Well, Ryan, what do you think? What are you looking for this morning out of CPI? Because I'm gonna give you my expectations after I hear from you guys. I'm gonna give you my I don't know, my playbook, if you will, from yesterday. We kind of changed things up a little bit yesterday for my week ahead video, and I'll talk about that here in a moment. But Ryan, what are you thinking this morning?
I think you've got to expect that the trend is going to continue. The PPI last week suggested that as well, with lower, big chunk low in PPI. There's no reason right now why inflation should be higher than it was last month. Therefore, that makes it the bigger shock if it is. I think you've got to look at it in varying degrees. If we're coming in between last month and the expectations, so for example, the headline CPI is expected at 7.3. 7.7 last month. If we come in between there, as long as it confirms inflation is lower, that's going to be sort of the more neutral reaction there. It's as you were. I doubt we'll see new lows in yields, new lows in the dollar, anything like that. If we get a big lower beat or miss, whichever way you want to look at it, so below 7.3 in the headline, below 6.1 in the core, and I mean, by 5 pips or more, then we're going to see a bigger reaction in the dollar. But I would expect it to come in confirming the trend that inflation is still coming down for now.
Okay, I think a lot of people really have expectations that inflation is going to moderate over the next year, and that's one of the real big reasons why we've seen this big bounce in risk. But the question is going to be not just not just what happens today, but how Powell's going to react to it tomorrow. If you're looking at ForexAnalytix, reading the analysis last night, looks like we're going to rally back to the 200 DMA, which is just above the 4,000 level. We are at that was from last night. We are at the 200 DMA. Amazing again, right? Here we go. We've got the S&P getting right back to the mean, if you will. Very neutral here, and I think that we have a big breakout looming between 4,100 and 3,900, and the question is which way we're going to break. So, K-Man, let me get your opinion. What do you think we should be doing with the CPI, and how are you going to play it?
Okay, so the market is gearing up towards a weak one, right? S&P is up 100 points since yesterday.
Yeah.
The stuff like Kiwi, cable as well. Dollar is a bit on the defensive, although less versus yen and euro hasn't moved that much. I'm looking to play it. So the base case is it's probably coming off like the rest. We can expect it to be a bit lower, but the bigger mover here would be disappointment, meaning that it comes in higher than what people are looking for. So in that case, I think with the central banks coming up and knowing that, for instance, Bank of Japan shouldn't be moving anything because the officials said as much over the past couple of days, I think dollar yen could spike.
Big rejections in dollar yen, right?
Sorry?
Big rejections in dollar yen around this 138 level.
Oh, yeah, 138 is the big level, but then levels are made to be broken, right?
Yeah.
That's, well, or not.
Maybe not.
No, I think that. So I think if we get a higher than expected number, I think stuff like dollar yen could take off. And then if in turn we are getting the real confirmation that the inflation is coming down, then likely stuff is going to weigh quite heavily on the yields. I think stuff like metals could shoot, and there's one in particular that I mentioned as well on the Flow Show, which is still doing very good. It's a Kiwi, and I would be prepared to pay up for some more Kiwi if it's really coming lower. Despite RBNZ having sent out a few warnings, Kiwi is just not coming off, and it's still a candidate if the dollar takes a hit that this could push further. And the last one that I'm looking at, I think if the CPI comes again higher than expected, then I think probably dollar China will be trading well above 7 again.
Okay. Really good look. Hey, I want to ask you guys really quick, Stelios, before I get your opinion here, on CPI. This sterling is extremely well bid right now. And I mean, it's not coming off of 123. I mean, if you're trying to short the sterling, you're probably banging your head against the wall right now. And I would imagine a little nervous going into this data. Now, if the data comes in stronger, obviously if we have CPI come in a little bit stronger, you're going to get a dip in the sterling, in the pound. The cable might dip a little bit, but based on price action, this thing's probably going to get scooped up on any dip. What do you guys think here? And why is it so damn strong? You guys live in the UK. You could tell me.
It's not because of us.
Well, it's not. Are you guys going to get like a cold winter, or have you guys been wearing flip flops and shades all winter? What's going on over there?
We're not in Greece, so no, I don't know. I mean, there is there's been a bit of a lift in rate expectations based on the jobs report this morning, and particularly wages. They've all come in higher. There's public sector pay has been boosted, wages running in the 6%, so that has drawn up rate expectations a little bit this morning. But then if you look at euro sterling, to get a gauge of what's happening really in the quid, it's looking a bit softer, but nothing huge. So I think cable's always cable. It's always got that additional volatility in it compared to the euro. Looking at the 1 month vols, cable's at 11%, euro dollar's at 9.5%. So it's always going to give you that extra bang for your buck.
Yeah.
On moves. And like you say, cable, a strong CPI data, cable could be down at 122 in a flash. If it's weak, it could be up at 124 in a flash. And you might get 50 pips out of euro dollar. That's what you're talking about. But I think you may be right. I think if you get a dip in cable, it's looking far more stronger than euro dollar. Might be the dip that's worth buying.
Yeah, I mean, I just sit here and look at it, and I'm not trading it. I'm just watching it, and I mean, it's hard to sit here and look at it and go, oh, we should just be shorting it right now. I mean, it's just grinding into a wedge up against the 123 level. Anyway, interesting. K-Man, do you have any thoughts here in the sterling?
Yeah, I mean, I'm exactly the same. It's been bought up, and we can only see that it's very big, and I've noticed that end of last week as well already. So I was long euro sterling, and I let them go because the sterling was just quite big. And I must say, with the central banks coming up, Bank of England is the one where I really don't know what the outcome may be, because it's anywhere between 25 is probably going to be too small, but between 50, 75 BPs hike. But what's the message that they are going to send? I have no idea, really no idea. This time, I'm really going to be a spectator in sterling, to be honest.
It's a great point that you bring up, K-Man, that we also have the ECB and the Bank of England on Thursday. So very important.
I was just going to add one thing, guys. Good morning.
Listening to my heart says cable should somewhere not be up here at 123, 124. It's probably a sell, but I mean, price action tells completely otherwise. Sorry, Stel, go ahead.
No, sorry about that. I was just going to say that the danger for bulls is that, like you correctly said, we're waiting for the Bank of England later this week, and it's not a done deal that it's going to be 50 or 75. We're kind of in the middle. So I personally think history has told us that the Bank of England under-delivers when it can, and also if we get the Fed hiking 50, there's the usual we follow what the Fed does. So I think that it's going to be a 50, and the market is not pricing 50; it's pricing a little bit more. So I think that could be a reason for sterling to underperform. Having said all that, I still think it is the pair to have if you want to take a bullish or a bearish view on the dollar, because it's right on the level there. So I think it's going to move 50 to 100 base, 50 to 100 pips either way, pretty quickly, depending on a hawkish or a dovish Fed. So that's this is going to move. You know,
let's not forget, it is, you know, it is nestled, you know, right above the 200-day moving average, you know, and we're holding above it for right now, and until we get below that, it's hard to get too bearish to sterling. So thank you guys for your comments. Hey, this is a good question. After I tell you guys my expectations for CPI, Charles did ask about rates, and I want to talk about that here in just a second, but I want to tell you guys my view on today's data, and I do expect that today is going to bring some volatility, and I don't necessarily agree that strong data is going to bring on a bigger reaction. But what I am looking for today is a stronger or inline or maybe a little bit stronger CPI data is going to spur a little bit of weakness in equities, but you have to step in to buy it. I think you got to step in to buy weakness in S&P, and you got to step in and sell dollars on any strength. So, you know, what I'm hoping for is I'm hoping that the euro does drop. You know, and you can see, you know, fib levels are drawn out here right now, you know, maybe a dip to 104.50, maybe it, you know, it depends on the data. I mean, obviously if the data is like bunker strong and we go, oh my God, I did not see that coming, I'll think twice about it. We're going to obviously be doing that live here in about 15 minutes. But, you know, if the data is like in line, maybe slightly, you know, higher than expected, you know, it's not a 5% print year over year. It's a 6.3, something like that. You know, the euro is probably going to dip, and we're probably going to see a move like this, but I expect a similar unwind, just like we saw in producer prices ahead of the Fed tomorrow. So I think the market is running into, you know, tomorrow with the expectations that the Fed chair is going to start to recognize that we are heading into a big recession next year, and that that inflation is probably going to be turning at some point in 2023. So, I mean, the market, I think it has this insatiable desire to be long, and you have asset managers that are just buying these dips, and you have to continue to play that way into year end. Now, I think next year, you know, game on, and I'm going to be looking for selling risk opportunities, but I'm hoping, and again, this is all hope. I hope we get to sell the S&Ps closer to 4,300, you know, at the beginning of next year. But I think that we are in the month of December. Everybody's going to try to shoot holes in whatever Powell does tomorrow, and they're going to try to, you know, make him, you know, everybody's going to be like, well, he was hawkish, but he could have been more hawkish. I think that's going to be the tone tomorrow, and people are going to buy risk following the Fed. So anyway, hoping for a stronger data, hoping for a little bit of dip in risk, hoping for a little bit of a strength in the dollar, and I'm going to probably sell that risk. And you can see the dollar index very well nestled in this this downtrend, and we are below the 200-day moving average here in the dollar index. Anyway, that's my quick view. We're obviously going to do live analysis in 12 minutes when the data comes out. But let's talk a little bit about rates, because I don't know what to do in the bond market right now. And how do you think this data is going to affect the market? Because you take the 30 years coming out of an ascending wedge. You got the 10-year also coming out of an ascending wedge. So do bonds continue to move lower and rates go higher following this data? I mean, what do you guys think? What's the trade here? Ryan, let's start with you.
Well, you've got to follow it. I look more from the yield perspective than the price perspective, and you got to look at two things. You got to look at the 10-year, and something like dollar yen is walking hand in hand with 10 years right now, intraday. So you got to look at the 10-year, because that is a good gauge for, you know, the uninitiated trader to look at what yield expectations are. We've seen a dip in the 10-year yields. It's come down to what, 3.4%. That's happened since the last FOMC, since the CPI report, PPI reports, Powell at Brookings, All that has created a move down to 3.4%. We haven't gone lower. That's your marker for today. That's your marker for the Fed tomorrow. If they're hawkish, dovish, whatever which way, if they're dovish, we can't break 3.4%. That tells you the market has, it's happy where it's pricing things further down the line. Then you've got to look at 2 years, because 2 years is going to be reflective of the Fed ceiling. So where their dots are going to go tomorrow. And everyone, pretty much all of them, have told us the dots are likely to be higher than where they were at the last projections meeting. So does that mean we're going to step up in 2 years to maybe 4.5% to 5% mark? We've been trading pretty much 425, 465, that sort of area. Yeah. If it's going to step up, that's going to bring potentially a lift in the dollar, at least for those short-term expectations. So really, are we going to, it's the old situation, is the CPI, is the Fed going to break us out of levels that we have been defining recently? And if we don't, you know how to trade it. If we do, then you also know how to trade it. You go with the breaks, or you go with the holds, and that's how you reflect it in the dollar and FX as well.
All right. Well, and I sit here and look at the bond market, and it definitely, I question. By the way, sterling just hit new highs. Did we have some?
No, somebody knows something apparently.
Yeah,
risk is getting risk is bid.
Yeah. I guess maybe we get some weak data. Well, we'll see. I think it's just actually a little position squaring and little market maker squeezing right now, just trying to squeeze all the stops out of all the retail traders out there that were just short sterling with stops above 123.10. They just all got whacked. So Stelios, what do you think about the bond market? You have any thoughts?
Yeah, I was going to say, we're at the point now where we're discussing whether after tomorrow's 50 there's going to be another 50 or another 75 or another 100, and are they going to stay on hold for 2 or 3 months or 6 or 8? I don't think any of this has any effect on the 30-year, because it's just such a long duration. Obviously it does have an effect if short rates rocket up, or collapse. That's going to have an effect on the 30-year. But the long end of the curve, I have traded it before when I was a market maker. It gets driven 90% by flows. So that's one thing. The 10-year obviously does get affected a lot more. My view is that yields are on a risk-reward level. Like Ryan said, the lows on the 10-year to 340. It's risk rewards. I think it's probably better to be short bonds, so long yields, simply because we've gone a bit too fast, a bit too far ahead of the Fed, and I do think that the risk is for Jay Powell to not be as dovish as expected. Now, having said that, if today's CPI comes in really low, then maybe all bets are off for tomorrow, but we don't have that number yet. We really don't.
All right. Well, K-Man, do you have any thoughts on the bond market really quick, just before let's do a quick run around the world, in the markets just before CPI comes out. But what are your views here?
No, in 2 words, nothing. We're in the middle of 340 and 375 on the 10s. So we're rather in the middle there, and the twos, they will probably react more tomorrow on the FOMC. What I'd expect anyway. And the 10s, we've got call it 15 or 20 BPs either side. I'm not sure we're going to break either side today, unless we get a number which is really out of whack. That's it. Really, I think we're in the middle of the ballpark now at around 316, the 10s.
All right. Okay. Well, that's fair enough. So I think what we should do really quick, I'm going to just go ahead and put this in here in the chat box for everybody. If you guys haven't checked out the trader funding program, make sure you do so. Do so after this, after today, when things kind of calm down between now and FOMC. If you want to learn how to trade our money and risk our money and not your own money, watch this 2-minute video. I just put the link in the description. It's a good time to be involved because, you got the FOMC tomorrow, so you can get a nice run at passing your assessment. But also, it's a good way to kick off the new year. So let's cover just a couple of key instruments here. With the euro, we have a nice little bullish wedge developing, and that's the one thing that you gotta keep in mind. You start getting below about 105 and change, just like right around 105, you're gonna see some downside pressure today. If we get some strong data and we break through 105, it's obviously gonna push us, into the 104, probably mid 104s, maybe even lower 104s, and that's where I'm gonna be kind of perched out, waiting to pick up some euro if we can get down there. I don't know if the reaction is going to be that big, but we're wedged up here. So now it seems like the natural reaction is the bullish wedge setup. So a break above 106 is definitely going to start squeezing some people. And if we make it above that, don't forget this bull flag pattern actually completes around 107.75. So what I'm trying to say here is, if the CPI data is weak, you could see the euro run, because then it's going to start squeezing people ahead of the Fed, and no one's going to want to stand in the way. So just keep that in mind. Sterling, kind of same situation. We make it above 123.50. Next thing you know, we have the long-term 618 retracement way up here at 127, 128. I don't think we're going anywhere near there today, but what I want to say is there's a lot of open air between where we're currently at 120, just sub 123 or 123. We get above 123.5, and there's not a lot stopping us, right? And squeezes are nasty. If they start happening, in a day like today, if the CPI data comes in weak, you got the Fed tomorrow, everybody starts thinking the same thing. Shoot, the Powell's going to be he's going to be weak at his knees, and he's going to show a little dovishness, and I don't want to sit around and be long, dollars in that event. And next thing you know, it's just a self-fulfilling prophecy, and you start seeing a squeeze higher. Now, I'm hoping that doesn't happen. I hope we see a little bit of a dip down to 121.5 today. I'll be a buyer down there if we can. The Aussie and the Kiwi both very, very much sideways in these ascending channels. So just keep that in mind. Like the Aussie's like in no man's land right now, stuck between we're at a 618 retracement. Long-term 38% retracement is right here at 68.70. And every probe up there has been swatted down. So you can see as we get up there, the market just swats it right down. But we're in this ascending channel, nothing to really deal with. Dollar yen, as K-Man pointed out a little bit earlier, really key is at 138. This is a 24% retracement. So if we can get above 138, like let's say that data is strong, which that's the unexpected move, right? But let's say the data is strong, we could get the dollar yen squeezing above 138 and seeing 140 again. I haven't traded the dollar yen a lot, so I'm not the right person to be listening to the dollar yen, but the person to be listening to happens to be live right now. And K-Man, I would be following what he's doing in the chat room because he's slaying that thing over there. Let's take a real quick look at gold. The gold market, we're in this very similar ascending channel. You can't be bearish gold while you're above this support. You can see this right here. That's a 50% retracement. A is a 50% retracement. B, it's those lows right there. So it's like 1765, 1770, depending if you're looking at futures or the spot. But you can see that channel support also comes in right there. And so, you got triple confluence. If we break through, let's say the dollar strengthens because CPI is hot, gold's going to come down. And if it breaks through 1765, we should see 1730 again. And this is going to be do or die for the bulls. Bulls need to hold that. They need to hold that, and they need to hold that. So if we do see a dip to 1730, the bulls need to step up and be buyers down there. Because if we break that, I think you're going to have a lot of disappointed traders. Because a lot of people have been buying gold because what silver's been doing, right, Stel?
Right. We're a minute away. We're a minute away.
All right, we are a minute away. So let's get ahead and get set up. So here's the dollar index. I'm going to put us right here, right there. And I'm going to keep a 15-minute chart, but I'm going to put on a couple of different panes so we can watch not only the dollar, we're going to watch gold, we're going to watch the S&P. And what the hell is the S&P doing way up there? There we go. There's the SPOOs. Right, here's gold, and here is the dollar, and then we're going to go to ForexAnalytix. We're going to grab one of the tools that comes with ForexAnalytix, which is Data Flash. You guys get this included with the Trader Funding Program, by the way, because you get into our community by by the way. This is our community. Everybody can say hello. There's you guys are on Jumbotron. That's our community right there. But you guys are included in that in the trader funding program. So how much time we got? Ooh, 10 seconds. Here we go, guys.
5 seconds.
Woohoo! Everybody ready?
Oh,
No more
something's
bets.
moving. Something's moving.
Wow.
What? What is the number?
Whoa.
Oh,
Six-
7.1 and
6.1.
6%.
Whoa. Well,
Yeah.
I guess you're not going to be able to you know, you're not going to be able to buy the cable at 122 and some change. That sucks.
Yeah, that's
Wow,
cool.
dollar yen 135, 30, 40.
Wow. I mean, you know, the euro is just demolished. I mean, oh my God. That sucks. You know, or excuse me, the dollar is. That just sucks because I really, really thought that you know, we would play we'd be able to play some dollars on the short side, but on a dip and you know, or on a bounce. And so I thought the euro would be a little bit lower, and that sucks, man. So now think about that, what we were just talking about. You're short dollars for whatever reason, and you just saw that CPI data come out. And I want to get your instant analysis here, guys, because you just saw that data come out, and how many of you really want to stay, you know, long dollars or
I've just
short
bought some.
stocks, you know?
I bought dollar yen at 44.
You what?
I think I bought dollar yen at 44. I think this might be.
Why are you fading this? Tell me why you're fading. I'm
I
just.
think it's a little bit of an overreaction. The Fed aren't going to cut rates tomorrow.
That's a good point. K-Man, what? Oh, he's probably left already. But hey, look, S&P right up in the 4100.
I've got a bit of kiwi and I've got a bit of silver, as I said earlier. So
you're playing kiwi to the long side. I like it. You're not falling for this then. All right.
Aussie dollar's right on resistance as well. 68.50, the prior high. It's had the break above 68. Again, it's all going to be about, can it hold these breaks? You know, it's broken 68, hitting 68.50. Can it hold it, or are we going to fade out again?
Yeah, I was going to say, I don't know if I'd want to chase it necessarily into you know, the FOMC. You know, me personally wanting to establish new trades. But I think that's going to be what people are going to be asking, you know, going into today, going into later today, because if I was short the euro and I was like long dollars, I'd be looking at this going, oh, shoot, you know, Powell's going to end up being super dovish. And look at stocks. I mean, if you're fading the equity markets, you are not in good shape right now. I mean, you're
going to get your dream, Blake. You wanted to short it at 4,200.
Well, yeah, but I was thinking like in January.
Oh,
we might get that in mid-December. We might actually get that in a week as Santa Claus comes to town, right?
Yeah.
So yeah, big moves, guys. Hey, by the way, just FYI, because the stock market's fading here, I'm actually going to fade a little bit of euro just to play a little bit of dollars. And I got hit on a little bit here. So I just shorted some at 106.44. I'm not going to stick around too long, but if stocks are going to fade away from these highs, that means the euro is probably going to, you know, fade a little bit too. I just sold it right there at 44. So we'll see. I'm not going to stick around long. I'm going to keep my stops tight. All right, Dale. Hey, good luck with your interview. Good luck, everybody, with trading. Remember, we'll see you in the ForexAnalytix chat room. Here's everybody in the chat room. Come join our community. This is us just chatting about things this morning. Check out the Trader Funding Program, which is also today's sponsor. And Dale, have a great interview.
Thank you, Blake.
Thanks.
Anas El Haji, welcome back to F.A.C.E, my friend.
Good morning.
Good morning, buddy. So you're the guy I want to talk to. You know, with I'm not sure what the reaction in crude I would expect is probably popping with risk a little bit today. You have a presentation, so I'm not going to interrupt you a lot today, Anas. Just quickly before you get started, what do you think of the $70 level in WTI?
Well, in a sense, that was expected. As you know, that we launched this new Substack newsletter
Right.
about 9 days ago before OPEC meeting, and we warned in that letter. In fact, we made several predictions where we're really happy to see each one of them was spot on. And one of them was, look, if OPEC does not do anything, oil prices will decline by about $10. And that's what we saw, exactly about $10 decline in prices. So that was not a surprise at all by any mean. They might go even lower despite the opening in China, and I will discuss this today too. If you don't mind, I would like to share some slides.
Sure, go ahead. And it's at the bottom, the green screen share button.
Yeah,
you
for some reason the screen just disappeared on me for some reason. Okay.
How about now? See it?
The big screen where I do the share is not there anymore. So let me see what I can do here. Share screen. Okay. And
yeah, there you
let's go here. Okay.
Okay, it's coming up.
And yes. So I don't want to make it that formal, but at least I would like people to be familiar with some of the charts. This is the address for the Substack, and how can people reach me if they have any questions about what I'm saying today, especially the Twitter account. When we talk about OPEC, I think seriously OPEC should have done something in their meeting on Sunday. Everyone was looking for them to do something, and a lot of people were talking about they should have cut production. Now, I said this earlier, over a month ago, that they should cut production. But as I studied this, I found out that the cut is a bad idea, especially for political reasons, not only because of the Biden administration, but also because of members within the organization who are not going to cut anyway. But if we look at the objectives of OPEC+, the objectives of OPEC+ is to manage and balance the oil market. And within that, they want to reduce volatility. At the same time, they have another objective that prices must be high enough to stimulate investment. And investment not only within OPEC+, investment worldwide in upstream oil and gas, because they realize that the demand is way higher than what's going to be available. So these are the main objectives. The hidden objectives, of course, are revenues and high prices. They need the money.
Yeah.
And the idea here is, how can they do all of that? Manage and balance the market, reduce volatility. Prices must be high enough for investment and high enough for their spending too, and for their social programs and other things, and development and all these things. And the cut is not going to do it again, because some members are not going to cut. At the same time, there will be we already have seen the backlash from the Biden administration in October. It was a big, massive backlash, and the media just was crazy about the cut, although the impact of the cut basically was nothing. We already seen prices decline after that, which means that OPEC has better information than the Biden administration. So let's look at what OPEC should have done, or OPEC+. I'm not inserting my numbers here. This slide basically on the left side shows OPEC estimates of global oil demand in 2022 versus 2023. And looking at 2023, they see first quarter oil demand the same as the fourth quarter of 2022. Then we have a decline in demand in the second quarter. Then demand starts picking up, and then a massive growth in Q4 2023. A massive growth, where they expect oil demand to reach 103.4 million barrels a day.
Okay.
Which it's unprecedented.
Okay, that's with everyone in the world. Probably China is in gear by then.
Correct.
Part of it.
Everyone, almost everyone by then. But the idea here is to look at their fourth quarter 2022 versus fourth quarter 2023. They need, or we need, more than 2 million barrels a day, 2.1 million barrels a day extra above what they produce in the fourth quarter. Okay.
Yes.
Where that oil is going to come from, based on their estimates, and that's on the right side, we see that half of it will come from non-OPEC. A lot of people question that, whether we are going to have that growth in non-OPEC or not. The other half will come from OPEC. And the question is, okay, if OPEC use another 1 million, what's going to happen to their spare capacity? So that's why I'm bullish. This is one of the reasons why I'm bullish on Q4 2023 if we don't have a recession in 2023. Here is the problem. We have something called the call on OPEC. The call on OPEC is the difference between those two charts. So we have the demand on one side, we have non-OPEC on the other. You subtract them from each other, you get the call on OPEC, and that's the next slide. The next slide has two important things. People, when they talk about decline in oil prices in the fourth quarter, they talk about various reasons. They talk about fear of recession. They talk about the lockdowns in China, problems in Europe, etc., etc. But what people do not know is the following. You look at that chart, you see a solid green line. That's the 2022 estimates of the call on OPEC by OPEC itself. And then you look at what they actually produced, and that's the dotted line, and you can see that they actually produced 1 million barrels above that. 1 million barrels a day being dumped on the market above their estimates. Here's the problem with that. The problem is people who are bullish or who were bullish and ultra bullish on oil, they kept arguing. Some OPEC members are not meeting their quota, and therefore we are bullish. Prices should go up. And we've been trying to explain to them, you are looking at the wrong way. And this is the proof right there in front of them that this is the right way of looking at it, and it was bearish. And looking at the inability of OPEC members to increase the quota, just like someone saying, you know what, I want to live to be 100, but that person dies at 80. So what? I mean, his wish to live to 100 has no meaning, has no impact. And those bullish guys, basically, who are bullish on oil, basically been using that argument. Oh, he said 100. Okay, so that's where the problem is.
What about, okay, they've been wrong for a long time. I mean, since the invasion.
So, so here is the other point about this chart, which is very important. That's the million barrel. You can see the million barrel that OPEC has to add based on their estimates on the right side, which means that either their forecast is wrong, or they have to increase production by 1 million barrels a day. Again, I'm going to repeat that because this is very important. Either their forecasts are wrong, or they have to increase production by 1 million barrels a day. What is the problem? The problem is OPEC decided to cut instead of increasing. OPEC agreement to cut production is to the end of 2023, which means that that fourth quarter where they need to add 1 million, they need, based on their agreement, they have to cut, which means that they are going to renege on the agreement. They are going to change it to meet the global oil demand. But at the same time, we have problems in December. We've seen prices declining. Their revenues are declining. Volatility is increasing. Their main objectives that I mentioned earlier to manage the market and bring stability to the market did not happen. How can they do that? Well, the solution is not to cut production. The solution is literally to change, to change the contango in the Brent to backwardation. And it has to be a steep backwardation. And how can they do that? All they get to do is move the cut from the fourth quarter to the first quarter. Or if that's a problem because the cut is going to multiply in the first quarter and some members may not like it, well, make it distributed over the first half of the year. Since the demand is going to be weak relative to the second half, take that, because you are not going to cut anyway in fourth quarter based on the data that I just showed. So all they get to do, just move that cut to the first half or to the first quarter, and that's flip the curve to a steep backwardation, and they achieve all their objectives. Traders are happy. We have liquidity in the market, and everything is fine. We discussed this in details in the newsletter that we have on Substack. on Substack.
Okay.
The other issue is the EU sanctions on Russia. This is one issue that people should realize, that the expected major decline in Russian oil exports is not going to happen. People who did not study sanctions, people who are not familiar with the history of the oil market, they really need to stop making statements like this without any evidence. We have enough evidence from the ground and from history to show that Russian oil will continue to flow to the market. This is just one chart showing Russian crude exports via tankers this year, and you can see the increase in recent quarter. You can see that, and they are back to almost 5 million barrels a day, despite the sanctions and despite everything. And this chart, I think, is the most important chart I'm showing today. This is Russia's crude exports by destination, and I'm comparing November 2021 to November 2022. And what we have here is, if you look at the European share, 58% of Russian exports, 58%, that's 2.66 million barrels a day, used to go to Europe before the Ukraine crisis.
Right.
Now with the sanctions, people say, well, the sanctions are successful. Well, look at what the Russians are saying. The Russians are saying, we shifted our crude to Asia. So the narrative is completely different. The West is saying we reduce dependence on Russia, and Russia is saying, no, I reduce dependence on you.
Okay.
So they are shifting production, shifting exports. They shifted the percentage of exports to Europe in November was only, excuse me, I have this kind of dry cough for a while, and it's bothering me.
I'm sick as a dog, so I understand.
So the exports to Europe, November to November, declined by 1 million barrels a day, from 2.66 to 1.6. And you can see that in Asia, for example, the portion went from 28% to 48%. So that million literally shifted from 1.3 to 2.3, China, India, and others. Yeah. But what the point here, the main point is, in November, Russia exported 1.6 million to Europe, and then the sanctions were imposed on December 5th. So what would Russia do with the 1.6 million? Where that's going to go? That's why some people were saying, oh, Russian exports are going to decline by 1.6 million. That's a very static view. The fact is, and based on our research, that 1.6, it's a little bit exaggerated because some companies decided to take more to Europe before the sanctions hit. So the actual number is really about 1.4. From within that 1.4, about 1 million or 1.1, half of it will go to Asia and other OPEC Plus members. The other half basically will reach Europe under different names and different ways. Based on our estimate, the Russian exports probably would decline by about 300 to 400,000 barrels a day, and that's it, which is a non-event, especially with the OPEC Plus cut.
Okay, are they discounting the oil they're selling to Asia dramatically?
Sorry, will you repeat that question again?
Are they discounting the price?
Big time. In fact, it's being sold in the 40s now.
Okay, and,
so we are talking about $46,
$47. And that's okay for Russia to be having a fire sale, even though they're selling?
Okay, I will go back to that in just a minute. I just want to make a final comment on this chart, and then I'll answer that question. Okay. So the idea here is the decline in the end decline because of sanctions, about 300 to 400,000. They can put that under OPEC cut, or what we are going to see is we are going to see Russian companies going for maintenance and doing maintenance, and under maintenance they will say, oh well, our production declined by 300 to 400,000. Now to go back to your point, the Russians are making the following statement. They are saying that the average price for our oil in 2022 is similar to our average price in 2021, yet we ended up with a surplus in 2021 in the budget, and we're fine. So instead of looking at $100 prices in 90 and 80, they are saying, let's compare it to last year, and we are fine. So that's the Russian argument.
Okay.
Now, one other piece of news is Venezuela. As you know, the Biden administration gave a license extended the license to Chevron to help the PDVSA and its 2 joint ventures to bring up more production and more exports from Venezuela on, excuse me, on one condition, that the oil has to arrive in the United States. The oil has to go to the United States. This is very important for a different reason I will mention in a minute. But let's look at this chart here. This is Venezuelan exports and production. That green area is not only consumption, because when they were not able to export, their storage goes up. So that's why you see this kind of pyramid looking, or the triangle. That's really storage. But you can see production is about 670,000 barrels a day. There are 2 issues here. The Chevron story is not a big story, because the 2 joint ventures can add only 200,000 barrels a day, and that will take time. But they are able to ship some in the next 2 weeks. And as you know, it's heavy crude, heavy sour, which US refiners want. And the reason why the Biden administration is interested in Venezuela now, a few months ago, they allowed the Italian Eni and the Spanish Repsol, give them exemption to export Venezuelan oil to Europe. But now they are saying, no, you have to ship it to the United States. And the reason why, because if they want to use the SPR, most of the oil left in the SPR is light sweet, while refiners want the medium heavy, sour.
Okay.
So so the issue of Venezuela is not related to the quantity, is really related to the crude quality. However, if the Biden administration gives shale producers in the United States exemption to export natural gasoline, which we use, we donate to it by using C5, the letter C, and then number 5. This is a diluent. If they send about 125,000 to 150,000 a day, barrels a day to Venezuela to mix it with their oil so it can move in the pipelines, Venezuela can add about 300 to 400,000 barrels a day easily within a few weeks. So there could be something there if the exemptions extended to US shale producers. And of course, the Keystone Pipeline, we have a complete separate newsletter on this one. The expectations basically is that we are going to see a major decline in Cushing oil inventories. They are already low, as shown in this chart here, and we might end up with 2014 levels, almost 20 million barrels a day, or we might go even lower to 2008 levels after the financial crisis. The Keystone issue, the main issue, is about crude quality again. So crude quality is appearing in the Venezuelan decision. Crude quality is appearing here in the Keystone issue. If this lasts for another 2 weeks or so, then there will be pressure to import more from Latin America. But the problem is we have already problems in Ecuador because of weather in the last few days. So this is going to increase the prices of some crudes. So the impact is going to be on the differentials more than on the price level. So again, it is about crude quality.
Okay.
On the inventories, I think we still have a few minutes.
Yes.
Okay. On the inventories, U.S. commercial oil inventories been declining, as you can see in this chart. They are not by any standard. They are lower than previous years, but not low by historic standards. And as you can see, they are going kind of mostly counter to the historic trends. We've seen something like this in 2017, but that happened after OPEC plus basically cut export to the United States significantly. If you look at it by historical standard, that's why the ultra bulls have no case here, simply because, yes, we have this major decline, and you can see it on the chart on the right side, but you look at the history of it, and it's still way higher than the era before 2014. As you know, we have two major events, one in 2015 and one in 2020. 2015, we have the crash in the oil market, and 2020, we have the COVID. So you cannot put this as part of the 5-year average. So if you compare it to the era before 2014, the storage is still high. And if you look at gasoline, we have a serious problem. You can see the red line there, still really low. We need more, and we need US refiners to do more. But the question is, can they do more? And I'll show you another chart to prove this point. Of course, distillate, especially when we talk about diesel, heating oil, we have a serious problem. You can see how low we are. We have an improvement in recent weeks, but it's not enough. And people say, well, you cannot use those charts because you are not counting for demand. And therefore, we need to adjust it for some anchor. So we adjust this for the what we call days of cover. And you can still see that by days of cover, looking at how the level of inventories relative to consumption, it is still higher than way higher than in the past, especially before 2014. And for the SPR, yes, for the SPR, still not a big deal. We still have about 380 million barrels of oil in it. It's just the problem of the SPR right now, again, is crude quality. And to give it a different meaning, to look at it, what the decline is, this chart shows that, yes, we have a major decline in SPR, but the Biden administration is not draining the SPR. We still have a lot of oil in the SPR. And this is the final slide. If you look at what I said earlier about gasoline and diesel, this is the inputs into refineries versus refining capacity. Notice that the first takeaway from this chart is that from 2020 until now, we lost 1 million barrels a day in refining capacity. That's lost forever. That's it. It's gone. And we cannot build more refineries simply because of all the environmental regulations that we have. And the expansion of refineries is in question because the regulations in California are really forcing refiners to shut down. So we might see some expansion in Texas, but we are going to see a decline in capacity in California. And then you can see that the utilization basically and the inputs where that red arrow is, it went up. That's why we ended up with that increase in gasoline inventories and distillate inventories in the last few weeks, simply because refiners were able to crank up more of that. But the problem is, if US economy is really in full gear and we end up with like 3% economic growth, we have to import gasoline and diesel. Why? Because of refiners, not because of anything else. We don't have that much capacity left. And that's
not only the refiners, the pipelines. So you could have more refining capacity, but the difference in prices on things like natural gas in different parts of the U.S. is amazing.
Correct.
What people are paying, right?
But the only issue here is we can build pipelines even under the current environmental regulations. We can build more pipelines and solve this problem domestically. The problem is with refiners, we cannot. That's really the big difference between the pipelines and the refining capacity. And all of a sudden, now the United States, despite all the talk about energy security, energy independence, etc., all of a sudden, all of that gets ruined when we start importing gasoline and diesel from China, India, and Saudi Arabia.
Yeah, that's a game changer. So best guess in us, range on oil, 70 a floor. A lot of people, do you think that Biden's going to get his price? His limit order is going to be filled at 65?
Even if prices decline, and I think they might decline, he cannot. And the reason why he cannot, because he cannot sell and buy at the same time. He needs to sell everything he needs to sell. He's selling 15 million barrels today, and he already sold 4.5 last week. So we still have about 10 million. So he needs to sell them first. The other problem he has is we have the Congress mandated SPR sales, which he has not sold yet. So he cannot just sell on one side and buy just to be a joke. The other issue is, I don't think he is going to do that. And the reason why, think about it this way. If he wanted to fill the SPR, at certain price, and he end up with those idea that I'm going to go to the futures market, I'm going to sign those contracts, and I'm going to fill it at 65. What if Saudis crash the market and prices become 40? Democrats are going to go crazy because they all say, you know what? Democrats are subsidizing the fossil fuel industry by $25 a barrel.
Okay, interesting. All right. Well, Anas, enlightening presentation, and the best place for people to contact you and get your new newsletter and stay in touch. You have different contact information for these?
Sure, I have it here on the slides in the second page. I have the Twitter account, which is my first name, my last name.
Yes.
Here you go. They are right here, and the Substack is there. Now for the Substack, people can get 1 week free trial and read what's going on. Especially the one on the Keystone pipeline. I think the issue of crude quality and others, people will enjoy that.
Okay. Well, we always enjoy having you here. People appreciate you being here.
Thank you. Thank you very much.
You know, and much success with your new project. I'm sure.
Thank you very much. Appreciate it.
Anas El-Haji, everyone, my trading warrior brother. You
Thank
want to
you.
know about what's happening in energy? Go to Anas. Thank you. All right, so that's a wrap, everyone. You can join the team in 14 minutes on the Morning Edge. And Anas and I will get over our upper respiratory viruses by the next time we talk. A lot sooner, maybe. So everyone, don't just count your pips, count your blessings, and hopefully I'll be back tomorrow in better throat. Adios.